Welcome, everybody. Welcome to the latest podcast of Crashes and Taxes. I am, of course, your host for the quick podcast, Rebecca Walser. So excited to be with you today. And this is a video podcast, so if you're getting this on your iTunes, Apple, or Samsung, whatever it's called, Google Play or iTunes, Apple Play, it's fine. But also check it out on video if you have the time, because I'm going to show some graphs today that I will have to just describe to those of you that are listening by podcast. So great to be with you. And I want to talk today about really, I think what I would say as a tax lawyer. So I am a certified planner, but I am also a tax attorney, and I've been in finance since the 90s. So I won't date myself any more than that. But to just tell you that one of the most favored asset classes in the tax code is basically something that a lot of people don't leverage. A lot of people have a lot of negative connotations for it, and therefore they don't leverage it, or maybe they don't even know about it. And what's interesting this year is we've had a lot of people concerned about their assets, their asset accounts, their accounts that are in the market, their accounts that are growing with the market and also maybe potentially going down with the market, and they're looking for alternatives. And this asset class is one of the best alternatives for wealth building that is in a consistent, non-volatile way. So we use this a lot as a non-volatile or a buffer, a bucket, if you will, for our planning. But we also leverage the heck out of this for tax purposes. This is a huge tax planning tool that every tax lawyer since the 1900s, really, since the tax code came about, has used and has leveraged. And I want to just give you a big disclaimer here that if you can see my fiscal house that I'm now showing on the actual podcast, you will be able to tell that our planning is really involved with three substantial components. We call it a fiscal house or a financial house. We have a solid foundation. This might be all of your no risk assets, so cash, money markets, CDs, maybe some long-term government bonds. And then this asset class that we're going to talk about today is an alternative. That's a solid foundation, little to no risk, also little to no growth, because we have little to no risk. And with the interest rates as low as they are and as low as they have been, then basically we're not going to get a lot of return from these no risk asset classes. Then we have the extreme opposite end of the foundation, which is what we call the roof. And it's really literally a triangle roof. And this is the market that we know. Everybody knows stocks, bonds, mutual funds, ETFs, REITs, any variation of those five asset classes. That's basically the market. That's the roof of our fiscal house. And that's pretty much what Americans do. They have some money in some kind of liquid 6-month to 12-month reserve account or money market or some kind of CD or a laddered CD strategy. And then the rest they have up here in the roof, where they're in some kind of stock, bond, ETF, mutual fund, or REIT, or any variation thereof. And that's their totality of their planning, and they think they have a plan. They'll ask their advisor, what's my plan? What's my written income plan? And the advisor will say, oh, well, you have plenty of money. We've done the Monte Carlo simulation, so you should be fine pulling out 4% for the rest of your life. So there's a couple of problems with that planning technique. Number one, it talks not at all about taxes. So if all of the wealth that you've built up here in the market is pre-tax IRA or TSP or 401k or 403b or 409a or simple or SEP or a cash balance plan, any pre-tax money that you've got up here in the roof that will stay pre-tax, so you'll basically roll it out at retirement into a 401k, and then you'll distribute it from the 401k, that's pre-tax. And that is going to be taxable to you for the rest of your life. So if your advisor is telling you can afford to take out a 4% distribution for the rest of your life, that doesn't tell you anything about how much you're actually going to have net after federal and state income taxes to live off of, because those distributions from any kind of IRA are going to be taxable for the rest of your life, unless you've bothered to work with a tax planning or a tax strategist such as our firm and really figured out what is the best way to get this money converted to after tax, tax-free. Roth being one of those conversion opportunities, and this other asset class that we're talking about today being the other. The last thing that you can't see is what is the walls of our fiscal house. Those are the asset classes that are in between our foundation, which is basically no risk assets, and our roof, which is all of our risk assets, the market. What's in between the walls? we call these hybrid assets. And they really truly are hybrid assets. They're hybrid in the sense that they get properties from both the foundation, the safety bucket, and the roof where we have all of the risk. They have properties of both. So how can they have properties of both simultaneously? Because they're a hybrid. So basically, the hybrid asset classes do not have any risk of principal loss. So principal is 100% protected at all times, and that is contractually guaranteed in writing by a company, a financial services company. So you have a guarantee of no risk of principal loss, but you derive growth not from some small guaranteed 3% rate for 6 months or 2% rate for 6 months or some kind of interest rate that's so small right now wouldn't be worth us doing. You derive growth through options. Options are being taken on the asset classes that are in the market, in the roof. So we're getting principal protection, but growth through options on the asset classes that are in our highest risk category, which of course we know is our roof. And that's how we're getting growth without any risk of loss. Now, in years where the asset class that you're buying options on does not perform, then surely you can see that the option will expire unused and you will get no growth for that year. But your principal was not put at risk because your principal was not invested directly into an investment. So this is how we can get assets that have really substantially based market participation and growth, yet at all times we're preserving principal. And that's what's missing in a lot of people's financial planning. They either have something that's 100% safe with little to no return, or they have everything with 100% risk and they have very substantial risk in that case. And the only way that they're diversifying their risk is through basically allowing their advisor to risk class or asset class diversify them. And asset class diversification, as we've probably talked on another podcast, is not true diversification because it always leads to, when a crash comes, all, without exception, all asset classes that we use to diversify risk, all asset classes crash together with the exception of bonds. Individual bonds that you hold to maturity will basically not crash. But if you are holding a bond fund or if you're not holding bonds to maturity, then no, even bonds will not give you the safety that you're looking for. So that is the fiscal house in a nutshell. And a lot of people really come to our practice because they just simply want a more complete financial plan from an investment perspective. But I want to talk to you now for the rest of the time, for about the 8 minutes that we have left, a little bit under, about the most favored asset class in the tax code. And a lot of people, when I say this, and it's of course in my book, Wealth Unbroken, which you can get at Amazon, Barnes & Nobles, Walmart, Target, you can get this book everywhere, Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, and Even Death. When I talk about this asset class, you always get the know-it-all who's like, oh yeah, whatever, I don't want to use that, it's this, it's that. They have all these preconceived notions. And the funny thing is, they're not leveraging it. They don't understand it. They don't know what they're talking about. And they've completely shut their mind down because they heard one person say 500 years ago something negative about it and they didn't understand then what they were saying, and they just basically wrote the asset class off. And I tell people, listen, I do not pick what the tax code decides to tell me is the best asset class. We as tax professionals go to the tax code and we pick and use and leverage what the tax code tells us is the most basically the most effective tax plan that there is. So that's what we do. We leverage what the tax code tells us. We don't leverage what we like or what we think. We have to leverage what the code says. Sorry about that, it was an alert. So what does the code say? Well, since the beginning of the tax code in the mid-1900s, cash value life insurance, overfunded cash value life insurance is one of the, if not, it is the most favored asset class in the code. The reason for that, there's probably 4 different provisions for life insurance, the most famous being 101A, section 101A of the tax code. But the most famous reasons for life insurance being tax favored is that you can build, or what we call overbuild, cash into the policy beyond the cost of the death benefit. And then you can access that cash as long as you stay within the framework of the policy as it was designed to be tax free. As long as you stay within that framework, it's a permanent policy. You will pass away with that policy intact. And all distributions from that policy and all the growth of those distributions from that policy are not only not taxable, but also not even reportable to the IRS. They're not counted as cash income. They're just simply cash flow that is not reportable to the IRS, which is a difference with the Roth, because even though the Roth will always remain, in my opinion, tax-free, the Roth is going to be always reportable every year. Your distributions, tax-free or otherwise, will be reportable, and that's through the 1099 custodial process. The custodian will send a 1099 every year by your Social Security number and report that Roth income, even though it will remain tax-free. That will impact other things like your Social Security taxation, your Medicare premiums that you must pay, and those kinds of things. So life insurance is not only non-taxable, but it is also non-reportable as long as you stay within the parameters of the way the life insurance contract was designed within the tax law features that the U.S. government has allowed, the federal government. So what does this mean? This means that we can put more money into the policy than what the actual death benefit costs. And then after we've finished funding that policy and we're now in distribution mode, we can go and take money from that policy plus its growth and have that come out to us for a substantial amount of time. And then even when we pass away, we don't, we then get, even after all of those distributions, a net death benefit. So we have a substantial cash flow during life, and we have a net death benefit. So all of that is not only tax-free, but it's not reportable. There's some estate tax issues. If you have an estate tax and you have a large life death benefit, we'd have to do some estate tax planning, but that is way beyond the scope of this quick podcast. So I just want to let you know that if you have not looked at or have not leveraged overfunded cash value life insurance, then you really ought to. If you want to know where it falls as an asset class on our fiscal house that we've been talking about, the foundation, the walls, and the roof, well, whole life, which is probably the blue chip of life insurance, has been around since the beginning of the country. Whole life is really, I would consider that a U.S. bond alternative, a U.S. Treasury bond alternative that is whole life. It is a solid, confirmed player. You're going to get a dividend every year if you're using the right kind of policy. So you need to make sure you're using the right kind of policy. This is why you need to deal with an expert on these things. But if you're using the right kind of policy and it's got the right kind of distribution in the contract, then that's really a bond alternative, and that's in the foundation. It's a really foundational asset. It's got a decent return every year, but again, it's safe and it's a foundational asset, but it's a good thing to use. If you are looking for something that's a little more, growth oriented and more subject to, the market and what's going on with the market, then you can look to a wall, and that's where you'd see index life. Index life is a life insurance contract where the growth of the contract, again, is derived through options on some kind of asset class that is still up here in the market or the roof as we design our financial house. So index life will be growth through options on the market. Where the market doesn't perform, the option expires unused and there's still no principal loss. And on the whole life side, you're going to get a dividend every year based on the profits of the company and some other factors. So you have to use good companies. You have to use companies that have been around for hundreds of years and are highly rated and all of these things, and have very low costs, because everything can blow up. That's one of the things that people say, oh, it's so expensive. It is if you use the wrong contract. It is if you use the wrong company. If you are working with somebody who's designing this policy and who does this from a tax perspective and from a planning perspective of your whole income, then no, we should not have a cost problem. We should not have a cost issue. But there are a lot of contracts that are being sold every single day that do have cost issues. So again, you must work with someone who leverages life as one of the tools. For those people that are saying, oh, this is a life insurance podcast, yes, it is. Because life insurance, by definition under the IRC, the Internal Revenue Code, is the most tax advantage and tax favored asset class there is. We would be dumb. I would be a terrible tax attorney if I did not leverage the fact that life insurance is basically tax-free during your lifetime and through your death. That is a tremendous way to transfer tax-free assets to your children and to your grandchildren. And if you haven't done it, then it's because someone told you along the way, tried to scare you away from it. Let me tell you why. Looking back at our fiscal house, the people that have their wealth up here in the market, the people in the market, Wall Street specifically, doesn't want money to go down here into the walls, into alternative asset classes, or down here into the foundation. They want all the money up here in the market so they can manage it and run it, and that's what they want. They don't want an alternative asset class. They don't, if it does not exist in the three triangles of the triangle for the market, stocks, bonds, mutual funds, ETFs, REITs, or any variation thereof, they don't think it's an asset class. So that's why you hear so much negative information about life insurance, because they don't want it as a competitor. The truth is, it is a tax-free asset class, and outside of the Roth, you can't get that same tax character in market-based investments. I'm going to close with this. I'm going to tell you, for those of you who think, okay, she's just a life insurance planner. No. I'm showing now one of our plans. And if all I did was a life insurance contract, we would just have a life insurance illustration. Our plans are very comprehensive. They are multi-dimensional, and they have a tax component as well as the actual investments. So if you're not working with somebody who can build a 40-year projection at your retirement of what assets will produce what and what the tax consequences will be, and if any tax strategy needs to be implemented before you get to retirement, then you probably really aren't working with a holistic advisor like we are at Walser Wealth. And if you do and you have, then I think you should definitely talk to that advisor about the opportunity that we have right now to leverage life, to move assets from taxable to never taxed again, tax-free life, while the tax rates are where they are. Because we all know that they are going up, that things are changing, it's not going to last too much longer. I'm Rebecca Walser. I think that's about as much as I can get in 16 minutes. I'm even over, so I'm with you. I appreciate having this podcast, Crashes and Taxes. Tell your friends, tell your family, subscribe, and basically give us a review. We appreciate all the 5-star reviews we can get for giving out great information, and have a great one until next time.